1. Fixed and variable costs. Break-even point, definition, examples in the open pit and underground. Costs: the value of various factors of production consumed in a given period, expressed in monetary units, in order to produce specific products. Provide specific services and perform functions related to the normal business of the enterprise. Fixed costs are costs that in the considered scope of production volume are not dependent on the production volume. Variable costs are those costs which in the considered scope of production volume increase with the increase in production volume. In both of these groups, there is a classification of them into unit costs, illustrates the cost per production unit. Total costs, value of factors of production used in a given period to produce a certain amount of goods. Average fixed cost is found by dividing total fixed cost by the corresponding output, Q, equals. Average variable cost is calculated by dividing total variable cost by the corresponding output, Q, equals. Break-even point. In terms of volume, BEP, Q, the level of sales at which the total revenue is equal to the total cost, the company does not generate losses or profits. In terms of value, BEP, W, the value of sales revenues, which equals the total cost, the company does not generate losses or profits. It is calculated by dividing total fixed cost by subtraction of price from average variable cost. Equals. Applications of break-even analysis. Setting a minimum price that will ensure equalization of revenues with costs. Assessment of unit variable cost, the exceeding of which causes imbalance between revenues and costs. Assessment of the sensitivity of the break-even point of sales to changes in the unit selling price, unit variable costs or fixed costs. Determining the level of product sales, quantity and value, necessary to cover total costs. 2 methods for assessing the profitability of investments. NPV, and others, what it is suitable for, advantages and disadvantages. 1. Simple methods, not taking into account the time value of money. Payback period, PBP, is the number of years a firm expects it will take to recover its original investment from net cash flows. Was the first formal method developed for the use in evaluating capital budgeting projects. The easiest way to calculate the payback period is to accumulate the project's net cash flows and see when they sum to zero. The payback period can be expressed by the following formula. Equals. Initial investment net cash flow per period. Advantages and disadvantages. Advantages. Disadvantages. Simplicity. Does not consider time value of money. Intuitive method. Cash flows after the payback are not taken into account. Provides the period in which the money invested is at risk. Is a measure of project's liquidity. 2 complex methods, taking into account the time value of money. Net present value, NPV. This is the present value of all inflows and expenses related to the implementation and operation of the investment project. The NPV value depends on the interest rate. As a method, it is based on the analysis of discounted cash flows at a given discount rate. As an NPV indicator, it is the difference between discounted cash flows and initial outlays. It is a method that determines how much future money is worth to us today. Will future profits cover investment outlays, but also expected profits? The interest rate is taken into account, taking into account the decline in the value of money over time. Advantages and disadvantages. Advantages. Disadvantages. Takes into account the time value of money. Difficulty of understanding the concept. Is the measure of company's value, shareholders' wealth, increase. Rankings depend on the discount rate. Allows comparison and correct decision-making on the selection of mutually exclusive projects. Projects of significant scale or economic life differences should not be directly compared. The NPV should always be higher than 0 in the assumed time horizon. Naturally, the higher the NPV, the better. However, the amount should always be related to the initial investment value as well. Internal rate of return, IR. The internal rate of return, IR, is the discount rate at which NPV is 0. If the actual discount rate is less than the IR, then the project is profitable. The method of calculating this indicator therefore also takes into account, as NPV, money changes over time and is based on the value of current expenditures and future inflows. Advantages and disadvantages. Disadvantages. Takes time value of money into account. Is not the project's rate of return. Has a rate of return character. Multiple IR for projects of cash flows of changing signs, sequence of in and out flows. Shows the maximum cost of capital that could be employed for the project. Should not be used for ranking of mutually exclusive projects. Modified internal rate of return, MER. Modified internal rate of return, MER, is the value of the discount rate for which the present value of investment expenditure is equal to the value of the current sum of cash flows that are invested each time. Profits from each year are immediately reinvested, e.g. put into deposit, and MER takes this into account, and IR was not reinvested. So as you know what IR is, the difference is only that in IR profits after obtaining them were, that is, they lost value. And in MER they are invested again, and in addition that they also lose value in time, like all money, they gain a little. 3. Financial liquidity and profitability of the enterprise. How is measured, which is more important and why? Financial liquidity, the enterprise's ability to meet, repay, the most due, short-term obligations, e.g. related to payment to contractors for goods and services, payment of remuneration, etc. Financial liquidity is the basic element that affects the assessment of a company's financial condition. The purpose of financial liquidity management is to maintain an adequate value of liquid cash and credit lines, as delays in fulfilling obligations result in distrust of contractors and crediting financial institutions, which may lead to bankruptcy. On the other hand, too high level of liquid cash causes freezing of a part of working capital, which does not support the operational activity of the enterprise, and thus reduces the profitability of the company's resources and profitability of sales. Loss of financial liquidity is the short-term inability of an enterprise to pay its liabilities on time. Loss of liquidity can turn into insolvency, which is characterized by the inability to pay all liabilities, regardless of whether they are due or not. The company's financial liquidity is measured by its ability to immediately accumulate cash from all available sources, such as a bank loan, the sale of unnecessary assets and other operations. Liquidity ratios have a narrower range. They allow you to assess the company's ability to repay its current liabilities, i.e. those whose payment is required within 1 year. Based on your cash and other current assets, in other words current assets. Current assets, i.e. assets that can be quickly liquefied, and thus converted into cash, in addition to cash, i.e. cash in hand, on the account, in the form of checks, etc. Usually include short-term deposits and short-term securities, bonds, receivables, and stocks. The option of quick sale of fixed assets or obtaining a bank loan is therefore not taken into account when calculating liquidity ratios. The basic information that will tell you how to manage your company's financial liquidity is: balance sheet. It is a presentation of the state of assets, and liabilities, sources of financing these assets. Basically, the balance sheet is created at the end of the financial year, which means that all balance sheet items are determined for this day. This is the so-called balance sheet moment. O profit and loss account. It is a list of financial operations carried out within a specified period, usually within a period of 1 year. The difference between revenues and costs shows whether the company made a profit or lost at a given time. O cash flow statement. It is a measurement of the company's financial result in a given period, which is the difference of cash inflows and expenses. Financial liquidity is shaped by several factors, which include current assets and their liquidity, the length of the operating cycle, sources of assets, mainly their ownership structure, share of equity in total capital, level of enterprise debt, debts, i.e. the share of current liabilities in debt, current liabilities, liabilities due, expired, etc. Financial liquidity measurement. The measurement of financial liquidity is possible thanks to financial indicators that illustrate the financial situation of the enterprise based on a summary of certain data from the financial statements. However, financial liquidity turns out to be a broader concept here, because through financial ratios we can, apart from financial liquidity alone, also determine the state of cash, the ability to convert assets into money, and the ability to cover the company's liabilities. Financial indicators have 3 basic characteristics. Measurability means that the indicator uses data that can be measured in some way, and these data are included in the financial statements. Comparability means that the result obtained in the financial indicator can be compared with the result obtained in a different time, industry, or planning perspective. Interpretability means that the result obtained in the financial indicator indicates to us a state that we can interpret and draw conclusions from it. 1. Current financial liquidity ratio. The current financial liquidity ratio indicates how many times the current assets cover current liabilities, i.e. whether the enterprise has sufficient funds to cover its current liabilities. In order for the financial balance to be maintained, it is assumed that the indicator should be in the range of 1. This means that the total assets should be twice as large as the liabilities. The low level of the indicator will mean that the company has no funds to settle its current liabilities. On the other hand, the high level of the ratio means that the company does not currently finance its activities through short-term liabilities. 2. Quick acid test, financial liquidity ratio. The accelerated liquidity ratio indicates the number of times liquidity assets cover the company's current liabilities. We do not take stock into account in this calculation. If the ratio is at 1.0, it means that the company is able to cover current liabilities. A high current ratio and low accelerated liquidity ratio means that the company has a high level of inventory, which is equivalent to freezing part of the capital. On the other hand, if the current ratio is low and the quick ratio is high, it means there is too little or no inventory, that the enterprise manages its funds unproductively. 3. Working capital. Working capital is the value we will receive by subtracting current liabilities in relation to suppliers due to unpaid bills for completed deliveries, employees due to remuneration, banks for short-term loans, state financing system for taxes, social security contributions, fees, and other current liabilities. For example, the net working capital, also known as working capital, may include inventories, goods, finished products, materials, semi-finished products and products in progress, advance payments for deliveries, short-term receivables, from taxes, subsidies, insurance, other, from supplies and services, pursued in court. Other, short-term investments, cash and other monetary assets, other short-term investments. Typically, changes in working capital are analyzed in terms of sales volume. Working capital should, in principle, change in proportion to the income from sales. Why is working capital important? Working capital helps the company maintain financial liquidity. It can be particularly useful when customers are in arrears with payments or when the entrepreneur has problems selling their goods. The presence of working capital means that you can continue your business without having to take loans. In addition, it protects against the consequences of financial loss, which can be very dangerous for the company. If a company has positive working capital, it means that it has a certain solvency margin, thanks to which it will be able to settle its liabilities, even in the event of a worse financial situation. Care should be taken to maintain an adequate level of net working capital in order to maintain an appropriate balance between the company's growth rate, its sales, and the level of current assets. Financial profitability means the degree of effectiveness of functioning and managing the company's assets. Profitability is the basic criterion for assessing the company's management. Analysts look at the company's profits in two ways: first, as a percentage of net sales, secondly, as a return on capital invested in the enterprise. The purpose of profitability analysis is to link the achieved financial result with sales revenues, owned resources, and equity. As a rule, the higher the profitability level of a given enterprise, the better the financial standing of the business. Profitability ratios are often considered the most important element of the analysis of the financial and property situation of an enterprise. Not only for people conducting business, but also for units and business entities from the immediate environment, e.g. contractors, customers, suppliers, banking institutions, etc. The basis for determining profitability are indicators showing the relationship between the amount of profit generated by the enterprise and the value of the factor whose profitability we intend to determine. An index analysis of the company's profitability is most often carried out in three main areas of activity: sales, ROS; assets, ROA; capital, RO. Return on sale, ROS, is calculated as the quotient of net profit earned by the company and the value of sales revenue generated. The obtained result informs about the extent to which a given sale is profitable, in other words, how much we have gained on one zloty of revenues from sales. Net profit margin equals When analyzing a given indicator, it is worth mentioning that no minimum value has been set for it. Therefore, the higher the sales profitability of a given enterprise, the better the efficiency. The basic assumption adopted by the entrepreneur should be to maintain profitability of sales at least at the same level for a longer period of operation. Therefore, increasing the value of the sales profitability ratio over time is tantamount to increasing its efficiency. It is worth emphasizing that it is not possible to indicate a specific value of the return on sales ratio that would be appropriate or expected by business owners. Its value largely depends not only on the size of the entity, but also on the industry in which it operates. In practice, the best solution is to compare the profitability of one enterprise with the profitability obtained by another enterprise but of a similar size and operating in the same industry, or compare the rate of return on sales in relation to 2 years. Return on assets, ROA, allows you to check the extent to which your total assets are capable of generating a profit. In other words, the ROA indicator shows the value of profit achieved using the assets owned, i.e. measures the efficiency of resource management. Equals higher than interest on savings accounts. The return on assets can be developed to examine the financial effectiveness of both groups of assets separately. Return on fixed assets. Current assets profitability ratio. In summary, the return on assets ratio is used in business to examine the quality and efficiency of business management. The other two indicators, being its extension, help in assessing the level and proper debt service. Equals higher than interest on savings accounts. Debt ratios. This group of indicators gives insight into the company's ability to pay long-term liabilities. Some of them compare the amount of shareholders' equity or operating profits with the amount and costs, interest, of funds provided by lenders. All these indicators are intended to show to what extent operational cash flows and the value of assets protect lenders in the event that the company suffers losses. The most commonly used debt ratios are equals less than 50 to 65%, too high is dangerous. Equals less than 1, too high is dangerous. Equals the higher the better, too low is dangerous. Equals the ratio of the value of foreign funds involved in the enterprise to own funds is an important indicator of the company's solvency. Using foreign capital, loans, borrowings, and other liabilities, is more risky for a company than financing with equity. Credits and loans require repayment of fixed interest on certain dates. If repayments are late, creditors can take legal action to declare the debtor's bankruptcy. Using equity is less risky. Dividends are paid depending on the decision of the general meeting of shareholders, and in case of difficulties the company is not obliged to pay them. The more equity the company has against its total debt, the more likely it is to cope with a crisis. On the other hand, an excess of equity in relation to borrowed capital is not a sign of efficient management. J.